We're speaking once again with Kiran Morzaria, Chief Executive at AIM-listed Cadence Minerals, Epic code KDNC. Back in September 2025, the company announced that heads of terms had been signed for a $4.6 million funding package to finance the restart of the Azteca plant at the Amapa iron ore project in Brazil. This week, that agreement has been executed and the clock is now ticking in the rundown to the restart of the Azteca plant and the first sales of iron ore concentrate. Hello, Kiran. How are you? Good to see you again.
Hello, Alan. Yep. Well, thank you very much.
Well, congratulations to you and the team. Many years of meticulous preparation and the agreement's now been executed. Assuming all goes well, am I right in thinking we are 7 months away from sales of the first iron ore concentrate produced at Azteca?
Yep, that's absolutely correct, Alan. So yes, once we get the mine installation is issued, the refurbishment, and once mine installation is issued, which will take around 4 months, 2 months of studies and 2 months for federal and local approval. Refurbishment and commissioning will take roughly 3 months, with ramp up and shipment shortly afterwards. So on current schedules, first revenue should be around mid-2026, which is what we've sort of outlined beforehand, and that remains achievable. From an investor perspective, the key takeaway is that the restart is now fully funded and deliverable.
Excellent, excellent. Well, of course, the recent oversubscribed fundraise that included £180,000 of investment from the Cadence board provided some £2.5 million in funding. How much does Cadence contribute to the Azteca plant, and also how will the income from sales be split?
So based on the offtake agreement that we executed, Cadence contributes roughly $400,000 worth of money into the offtake. The remaining amount of money will be funded by the offtaker partner. The structure gives us exposure to production and sales without further equity dilution, and expected to deliver around 70% internal rate of return on Cadence's capital. So effectively, if we look at it, that $400,000 is around 8-9% of the total offtake, and as a result, we'll get the pro rata around that 8 to 9% of the offtake repaid. So as that's getting repaid from shipments, we'll get 8% from all the repayments, and also we'll get 8% of any marketing fee that's from as we ship that material. Critically, that marketing fee actually applies. Let's say the Azteca plant or the Azteca deposit is larger than we expected, we would still continue to generate that marketing fee. So basically, Cadence gets its pro rata share of sales from day one of the shipment.
And of course, next June, Azteca will be cash flow positive from the off, I understand.
Yeah, absolutely. So the way that we modeled this is that as soon as we start production, that's cash flow positive for us based on our cost structure. So, and Cadence will get a portion of that cash flow based on its contribution to the offtake.
Excellent. Can you provide a bit more detail sort of on these numbers going forward? I mean, of course, the production revenues from Azteca will go towards tracking or fast tracking the recommissioning of the larger Amapa mine. How do you expect this to work in practice, given that Amapa still requires installation licenses and permits?
What we're talking about is the installation licenses for the mine will already be granted, right? By being able to start the Azteca plant, we'll already have the installation licenses for the mine. We'll already, and then what will remaining is the installation licenses for the port and rail. But we anticipate that work stream is continuing on in the background, and we expect those to be forthcoming soon after we get the installation license for the rail. After the mine, we'll get the rail and then the port. Nonetheless, we still have to do a definitive feasibility study on the larger project. And the beauty about this Azteca plant is, as a result of its cash flow, even after paying us back and the off-taker, it's 4.6 million plus the coupon plus the marketing fee, it will have free cash flow, and that free cash flow gets invested into the DFS initially, and and then eventually into if there's more free capital into parts of the development of the asset. So this is the key value point. We get near-term cash flow becomes growth capital and not further dilution.
Okay, so Azteca plant up and running, commences production of iron ore concentrates. Now, assuming the amapa licenses and permits are granted in line with those normal timeframes, what sequence of events will, looking forward, what sequence of events will need to take place to bring the amapa mine as a whole back into production?
So the sequence of events are Azteca, free cash flow, repay the offtake partner and ourselves at Cadence, with the remaining free cash flow on top of that, which will get larger as the repayment is completed. We complete the DFS. After the DFS, you've then got a bankable or a definitive feasibility study. That definitive feasibility study then allows you to raise the larger capital for the construction of the amapa larger 5.5 million tons DR grade project. Now, remember, this project is very large in terms of its revenue, in terms of its free cash flow. It's got an NPV of 1.9 billion. It has free cash flow forecasted over $356 million a year. So a real quantum of difference between Azteca and that. But of course, there is additional capital required for that. Now, the way that we're going to try and do this is effectively utilize some of the free cash flow that we get from amapa, assuming that the iron ore prices stay where they are, to fund part of the equity associated with the larger project. Then the remaining equity can come in from a joint venture partner, or a much larger offtaker or same offtaker, royalties. That becomes the equity stack of your larger project, and the remaining would be debt, and that debt will come from various sources, whether it be traditional debt, sort of bank debt from international markets, or in fact local debt from basically state-funded debt or regionally funded debt, which then funds the infrastructure, i.e. the port and the railway. So that is the sequence. And then after that money is secured, you have a commissioning time, which is about 18 months, and then into production. So that plan is a longer term plan, but for us, the critical point is that we now no longer, with this funding in place, theoretically, you no longer need to fund amapa on a day-to-day basis. It can fund its definitive feasibility study. Now, because the cash flow is over a period of time, definitive feasibility costs $6 million. So our definitive feasibility will be a gradual process to go through there, rather than seeking it all one shot from the equity. We get more organic growth to get to definitive feasibility study, to possibly even pay for some of the capital expenditure improvements associated with the DFS and the larger project, and that is obviously less dilution, and it's basically self-funding growth pathway.
That's a really good insight into the next steps, and I think investors will take a lot of encouragement from that, because you've really mapped that out clearly. So, but just back to the company itself. Over the past year, there have been various research notes written on Cadence and the amapa project, and they're all citing valuations, many multiples of where the current share price and market cap sit today. What do you think is needed to close that valuation gap? Well,
I can't comment on what other people will put in terms of their valuations. All I can say right now, that gap to us, it's about communication, but ultimately it's about execution. We get licensing, revenue, restart, and revenue. Those are catalysts. As we move from planning into production, the risk drops and the value case becomes tangible. The board invested in the recent raise because we believe that this delivery and also investment over a period of time, a very long period of time, we're nearly up to the £1 million mark between all board members. We've invested because we believe the delivery will re-rate the business, and it's not just a narrative.
Okay, well, before we go, could you provide us with a longer term series of events to bring amapa into production? Could you just summarize again near-term developments that investors should look out for in the run-up to first production at Azteca?
On a broader scale, it's going to be mine installation license, refurbishment, mobilization Azteca, and first production and first sales on a broader scale. But we're not going to limit the RNSs to that. We will obviously talk about how we're proceeding with the mine installation licenses, what studies are complete, when they're submitted. As the mobilization goes through, we'll be updating the market so that people can be kept in tune about what's happening on site. And of course, first production and first sales, that will be a really important announcement. But there are key value drivers across the next 7 months, which should further improve the price and our outlook. And basically, each step unlocks the next, and each should be value defining.
Well, big congratulations to you and the board once again on executing the agreement today, Kiran. We wish you every success with bringing Azteca online and, of course, fast-tracking the restart at amapa. Kiran Morzaria, Chief Executive at Cadence Minerals, thank you for joining us today.
You're welcome, Alan. Thank you.